How does the FOMC set the federal funds rate? Imagine a group of decision makers sitting around a table, carefully watching the economy like a weather forecast. That's how the Federal Open Market Committee operates when setting the federal funds rate. This rate is the interest banks charge each other for overnight loans of reserve balances. It's a key tool that influences the entire economy. The FOMC meets 8 times a year to decide where this rate should be. They look at economic data like employment numbers, inflation, and overall growth. Based on what they see, they set a target range for the federal funds rate. This range guides how much banks will pay or earn for reserves held at the Federal Reserve. To make sure the actual rate stays close to their target, the FOMC directs the Federal Reserve Bank of New York to buy or sell government securities. When the Fed buys securities, it adds reserves to banks, making borrowing cheaper. When it sells securities, reserves decrease, making borrowing more expensive. The Fed also sets the interest on reserve balances, which is the interest paid to banks on their reserves at the Fed. This rate acts as a floor because banks won't lend reserves at less than what they can earn risk-free from the Fed. Changing this interest rate is one of the main ways the FOMC influences the federal funds rate. The Fed also uses other tools like overnight reverse repurchase agreements and the discount rate to support their goals. They communicate their plans through forward guidance, which helps markets understand what to expect in the future. All these actions affect how much consumers and businesses pay to borrow money. When the FOMC raises the rate, borrowing costs go up, which can slow down economic activity. When they lower it, borrowing becomes cheaper, encouraging spending and investment. The goal is to keep the economy growing steadily while keeping inflation in check. The FOMC constantly monitors economic indicators and financial conditions to decide whether to increase, decrease, or hold the rate. This ongoing process helps balance growth and stability in the economy.